Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, last week CMHC came out with their latest housing market assessment and declared Toronto had dropped from the high-risk category. Why would they say that?
Why would they say that? I guess, the same reason, Jim, that they came to their assessment of it being overheated too late. They're always reading the market, a year, 2 years later than what they should be reading it. As, again, many of the times in the show here, we repeat ourselves over and over again. But, these things just keep coming up. The assessment, what they're basically saying is that, places like Vancouver and Toronto, where you've seen home buyers, spending less money, are now markets that have rapidly got out of the overheated or the risky housing market territory, which, we know is just a foolish comment. Housing markets do not move out of a risk category that quickly. I would prefer when they give these housing market assessments, Jim, that they were to tell the public exactly what's happening in a housing market. Because when the public is given the facts, as we continue to say, we believe they'll make a rational decision. The only time that they don't make a rational decision is when someone is selling them a message through a misinformation campaign about the housing market that is geared towards getting those issuing the message some revenue streams. We would say for CMHC, about 63% of the Canadian home buyers in 2019 were purchasing more home this year than they were able to buy last year for the exact same amount of money. In layman's terms, what that basically means, 63% of Canadian home buyers got a better deal in a house that they have in 2019 than they did in 2018 or 2017. CMHC doesn't measure housing markets this way. They measure housing markets, if you read into their methodology, that involves the use of real estate stats from the Canadian Real Estate Association. They use the sales to new listings ratio. CMHC doesn't use the listing rejection rate. Now, we have changed the term for this measurement a couple of times over the last couple of years. We used to call it the failure rate, but we've pretty much settled on the listing rejection rate because it is a great comparison for home buyers to use when looking at a housing market versus how the local realtors are telling them the housing market is functioning. In Calgary this month, in the province of Alberta, they're going to claim there's around a 57% new sales to listings ratio. In other words, 57% of all new listings sold. That is the information that is being shared with the public. That is the information, the exact same metric that CMHC will use in their housing market assessment for Alberta and Calgary and Edmonton. We would say the listing rejection rate in Calgary is 11%. Is at 89%. That means 89% of all listings presented to home buyers in the month were rejected by those home buyers and they weren't purchased. It sends a tremendously different message to home buyers when they hear 56% of all new listings are selling versus 89% of listings are being rejected by the home buyers. The same information is available. It's just how you present it to the public. One is a misinformation campaign designed solely to get the highest price possible in the shortest period of time for listings posted on the MLS system. One is designed to make commission easy for real estate agents to earn when they are failing the vast majority of the time. They're dealing with the public. In other words, the public doesn't actually buy a house from them. Versus the reality of the market, which is home buyers rejected 89% of all the listings that were shown to them in the month. Now, imagine if you're a home buyer, Jim, and you're told that 56 out of 100 homes will sell. You have a tendency to think, hey, that's a relatively okay housing market. Every 2 houses that I look at, 1 is going to sell this month, versus 9 of 10 houses that you look at won't sell. It is a radical difference in how the consumer makes a decision when buying a home. And this is basically what's happened with these market assessments from CMHC. They have trusted organized real estate because organized real estate wouldn't give them the data. Now, organized real estate is beginning to give them the data, but what CMHC, Statistics Canada, and every housing analyst has is 4 decades of misinformation about how to read a housing market. They believe everything that they've been sold by organized real estate. They believe it because it infiltrates all of the information that they've produced over the last 40 years. Every single report, every single commentary they provide to government politicians, every single comment they've made to the market, every single decision that is made about mortgage lending is all rooted in the use of these false metrics. The truth of the matter is, what CMHC simply should have said was 63% of Canadian home buyers got a better deal in 2019 than they did the year before. The reason why Canadian home buyers need to know that is so that they don't rush out and buy a house. When you hear 9 out of 10 listings is not selling, you're not going to rush out and buy a house. You're going to sit back and look. You're going to sit back and determine what's happening in the market. I use this example when I'm speaking to home buyers. If you look in the MLS, you go to your bank, you go to your financial advisor, you go to your parents. Everybody agrees you can spend $500,000 on a house. The very first thing you do is you go to realtor.ca, you type in $499,000, and you see what houses are available in your marketplace, priced at $499,000. Let's say that 20 houses come up, priced at $499,999. There's 20. You'll look at those 20 houses, and generally speaking, you'll see which ones are an open house this weekend. Let's say 10 of those 20 are an open house. Well, obviously, you don't have enough time on a weekend to go through 10 open houses, so you pick 4. What you've done is you have selected in your mind the 10 best properties, the 4 best properties that you'll go look at. The other 16 you personally have determined are inferior to the 4 you're going to go look at. One, because they're not an open house, half of them, and the other is you don't have time to see 60% of the ones that are offered an open house. You're going to go to the 4 best that you have available to you. You're going to look at those 4 best, and if you go into one of those 4 houses, all priced at $499,999, one of those 4 houses you will determine is the best. That will be your very first choice. If it's enough of a first choice, you're going to purchase that home, and that home will be removed from the market, leaving 19. Remember, you bought the best house. There is not a home buyer in Canada who looks at 4 homes, all priced at $499,000, and chooses the house that is not the best. They always choose the house that is the best, even if that best is specifically to them. 63% of all Canadian home buyers in 2019 got a better deal in 2019 than they did in 2018. It's got nothing to do with the risk of the housing market, as CMHC has proclaimed. Toronto's housing market is just as at risk, if not more, right now than it was last year or the year before. The Vancouver housing market right now is just as much at risk as it was last year, 2 years ago, or 3 years ago in 2016. Those markets have not changed one iota. The only thing that's changed is the opinion of Central Mortgage and Housing Corporation, who is relying upon housing market metrics created to get the highest price possible in the shortest period of time.
We'll have more with Ross Kay right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross Kay. Ross, this week we learned San Francisco will no longer charge as crimes personal decisions like peeing in public, dumping trash in the street, or camping out in someone else's backyard without permission. What will this do to property values there?
Well, what will it do to property values there, Jim? What I'll say is this is a lesson and a warning for both the city of Vancouver, the city of Toronto, arguably Hamilton and Montreal. There is a real lesson to be learned in the United States of America. Because even if you look at Seattle is a far different place than Vancouver. And it's a different place for this reason, Jim. San Francisco's homeownership rate is down to around 32%. Now, I understand that the government data will say it's around 36 in the United States. But we calculate homeownership rates based on residents. Anyone who's looked at a homeless person sleeping on a heating grate over the winter understands those people are residents of your city. You need to count all of those people. If you've got someone living in a van in a neighborhood parking lot, that needs to be counted. If you have someone living in a motorhome, that needs to be counted. If you have someone in a shelter, they need to be counted. So that means for us, when we're calculating home ownership rates, Seattle would come in around 32%. About 32% of the residents who live in San Francisco, or of the households, would own their home. Only 32%. That means 68% of the people voting municipally will be tenants. They will not be landowners. Now, this is not a statement on rental versus versus the owning lifestyle. This is simply commentary on how housing markets work. The rental tenant does not take care of the property themselves. They rely on the landlord to take care of the property. They pay a premium, technically, for the service the landlord provides. If the landlord needs to borrow $2,000 to put a new garage door on the property you're renting, sooner or later that will be added to your rent. You will pay the service fee associated with that. That means homeowners perceive their property and their community in a slightly different way because they view they are the ones paying for it. This has never been communicated in North America to tenants in any city that I know of. Tenants do not understand or do not think about they are actually the municipal taxpayer. The rent that they're being charged includes the property taxes in it. Not only are they fully paying for the home, the carrying charges, the improvements of the property, the renovation that's going to be needed, sooner or later, they're also paying for the monthly, yearly property taxes. That is all included in their rent that they're paying. Those tenants are never explained that that's what's happening for them because it doesn't serve a purpose. Landlords want you to think they're doing you a favor by leasing you the property. Realtors don't want you to understand every dollar that you're paying in a lease payment is actually paying for the house for somebody else. And I'm talking about realtors who are brokerages who are handing tenancy agreements. What you see in San Francisco is the ultimate consequence of a home ownership rate falling to the ridiculously low levels that you see in a lot of the major American cities. Seattle, if I'm not mistaken, is around 44%. That means 56% of municipal voters will be tenants in Seattle. Tenants are always going to ask for different things. Their focus will not be the same that the landlord or the homeowner focuses on. A homeowner does not want to see the value of their property decrease, so they will ask their municipal politicians to make sure nobody's peeing on their front yard. The tenants won't view it that way. They'll view it as simply as an expense because they're not making any gain in the property. The only gain that they're possibly making would be from a savings by renting versus owning. They're not viewing the ownership, the real estate situation in the same way. Thus, their vote is different. They may see things like dumping trash on the street as not being attractive, but they're not perceiving it to be as a lowering of the quality of life that they're going to have long term in that city. There is a threshold that we've calculated, and we believe it's around 63%. It should be the striving goal of every politician to have 63% of the households in a municipality being homeowners. Above that's okay, but below that is not. If your threshold is above that, then you should be adding more housing stock, because that means you can allow more people to be homeowners and you can allow more people to be tenants. In other words, your housing stock is going to grow, so if the percentages drop, the total numbers on both sides still increase. San Francisco is just the far out consequence of that. But when they talk for San, let's talk about Seattle. Let's go back to Seattle. Seattle is looking at an average median household income of around $87,000. That is substantially higher than the median household income in Canada. Now, the median household income in the United States is paid in American dollars. Canadians is paid in Canadian dollars. Americans also have to purchase health insurance. Canadians do not have to purchase health insurance. It's paid for in their income tax. The median property value in Seattle in 2017 was about $673,000. The relationship between the median household income and the median property value is 100% aligned. The problem that Seattle has is their home ownership rate is only around 44%. That means the poverty rate will also be higher, just by the nature of how a community evolves over time. What Toronto and Vancouver, Hamilton, Montreal need to be focused on is learning lessons from these American cities where they have let their population down. You need to be growing your housing stock rapidly enough that prices stay low enough so the incentive of owning versus leasing or renting increases. There's multiple financial reasons why you want that to happen for someone over their lifetime. But even as for a governmental oversight, you want this to happen because you want to maintain the quality of life in your city. When you're reading these things about allowing people to pee in your front yard, squatters to sleep in your backyard, people to pour garbage in the street, these are not something that you want to bring into your own city. And anyone who thinks the homeowners in San Francisco 20 years ago wanted this to happen is not making any common sense. This is an unintended consequence of a home ownership rate that falls below 63%. And in San Francisco, it's almost half what it should be as a bare minimum. We need to do everything that we can to encourage the growth of the housing stock rapidly enough to get prices down, allowing regular Canadians to be homeowners instead of tenants. We know that 30% of the population will continue to choose to rent. There won't be a rental vacancy problem in this country. The problem will always be, are we having enough of our Canadian citizens' households owning homes, building wealth slowly over their lifetime, and reducing their lifetime cost of living through owning the family. San Francisco is staring you in the face, Canada. San Francisco is staring every politician in a large urban city in this country in the face. It will change in 20 years, and in 2040, your city will not resemble what it is today. I really hope that's what they learn from San Francisco.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, property assessments are about to roll out for 2020 property taxes across Canada. What do you think the new year will bring on the municipal tax front?
It's going to bring a wide variety or a wide variance in changes to property tax assessments and subsequent property tax payable in a calendar year across the country, Jim. It is a radically different property assessment market, although they're both called market value assessments in British Columbia per se, versus Ontario. In British Columbia, your property tax is reassessed. Your property is reassessed every single year. It's reassessed as of July the 1st. That July 1st assessment is applied the following year. Now, what that means is that there is a quickening of changes to property tax payable for every single property in the province of British Columbia, specifically in the large urban centers like Vancouver and the greater Vancouver area. What that means is that a rapid decline in the price of single detached homes, say they drop 20% in a year, which we would say was 16 to 17. There was not a corresponding drop in condominium prices. Those prices take longer to drop. Let's say that for the sake of the argument that they just held steady because the way that the sales mix was. That meant the property tax base, property taxes being paid in a calendar year in 2017 shifted towards condo buyers, and it shifted away from single detached buyers. This is not debatable. This is simply a fact. 2018 happened again. Lesser property tax for single detached owners, higher property taxes for condos. This year, because both single detached and condos have dropped in price in the greater Vancouver area, the differentiation in that variance will not be as strong. Condos are still going to pick up more of the property tax. What this means is, over the last 3 years, condo property owners in the greater Vancouver area have increasingly paid higher and higher property taxes versus single detached owners who consistently have paid less and less and less. We go to Ontario, it's a different system. In Ontario, for 2020, you will be finally paying 2016 property tax. What Ontario does is it evaluates market value assessment, was evaluated back in July of 2016, or excuse me, January 1st, 2016. Whatever your property was assessed at that year, they compared it against 2012. If your property went up $100,000 in value, they add 1/4 of that each year for the next 4 years. So in year 2020, the full $100,000 change is added to your assessment. That means your property tax assessment increases all 4 years. If the property tax base increases over that period of time, or decreases over that period of time, that means your property taxes are going to go up. A totally different system than in British Columbia. So what that means to us, or what it should mean for housing analysts, housing market analysts, is that people who are on the tipping point of affordability, people who purchased a home in 2016, their property tax assessment has gone up for the next 4 years. they are this year going to be paying the full assessed value from way back in 2016. At the same time, the new assessments are going to roll out, and that 4-year phase-in period will take place again. Ontario is always 4 years, well, as much as 4 years behind with their property tax, where British Columbia is always only 1 year behind. Two totally different things. It's seldom, Jim, where the province of Ontario people get caught, but this is the case what's happening right now. Because the way that the property market is rolled over in Ontario and the way that the property taxes are assessed, you are going to have new assessments come due January the 1st who are not going to fully record the price drops that have taken place. And that means for the next 4 years, as a home's values are declining, your property tax assessment will be going up, and there's no way to get around it. Where in Vancouver, your property tax assessment drops each year, and depending on the category of home that you own, that means your property taxes are going to go up or they're going to go down. Basically, what I'm saying here is to all your listeners, and this includes tenants. This includes those of you who are renting a house, because if your property taxes go up, even in a rent-controlled environment, your landlord is able to go to the landlord and tenant board and ask for an increase in your rent to cover the added property tax. The landlord is not gouging you. His cost to own that property or her cost to own that property have increased. You as the tenant will pay that increase. You can forget all of these fake metrics about rising rent prices, which are geared by their nature to try to inflate rents to the benefit of landlords. In other words, if you stay in the same property in a rent-controlled environment, your rent payment cannot increase the way that you've read it in the news the last 4 and 5 years. The property taxes are a main component of your life. They're a main expense of your life. If you look at a median income of $70,000, household income of $70,000, and you're renting a property where the property taxes are $5,000, that means $5,000 of your after-tax earnings, not pre-tax, after-tax, is going to have to go to pay property tax. You're paying property taxes on flawed property tax models coast to coast. Any municipality, which as far as I know is all Canadian municipalities, that uses current market value to assess the property's values, have embraced a system that benefits the wealthy, the wealthiest in your community. The wealthiest in your community will be the owners of single detached homes. It is so disproportionately weighted towards single detached homeowners. I can't even begin to discuss in today's show. Those wealthy of your cities are going to see their property taxes decrease, while those newly in the property ladder will see their property taxes increase. You really need to look at property tax. You can't allow organized real estate to hide property taxes from you the way that they've strived to do for the last 40 years. If you look at the ownership calculators that are out there, use rateonrealtor.ca. The one rateonrealtor.ca, there's almost no focus on property tax. There's no explanation of how you need to calculate your property tax or how it's going to impact your cost of ownership each year of a 5-year term of your mortgage. They'll let you lock in your 5-year rate in the mortgage, but they won't apply an accelerator to the property tax payable over those 5 years, when that is really what you're going to be experiencing. Property taxes are something that every home buyer needs to focus on and look at, whether you're doing it for an ownership situation or an investing situation. You need to see how the property market is structured in your city so that you can plan what your property taxes are going to be going forward. Because you're going to own that property for a very long period of time. And if you're going to benefit from being undertaxed, it's just the same as finding a tax loophole on your income tax at the end of the year. Everyone wants to take advantage of it. Just nobody talks about it because it is a bit complicated and because it doesn't serve the interests of those involved in the home trading infrastructure.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.